Mortgage rates dropped significantly this past week, but what does that mean for you? Should you buy a home now, or should you wait for mortgage rates to continue to drop? Now, the meat of this video, what I'm going to dive into later, is why mortgage rates are dropping and why I personally believe we will see lower mortgage rates as we move throughout 2025. But to answer these questions, should you buy a home now, or should you wait for these mortgage rates to drop further? I think it depends on the specific market that you're in. If you are in a market that has an ample amount of inventory, somewhere like Florida or Texas, where they're already seeing home price declines and there's tons of homes on the market, I think if you're looking to purchase a property in one of those areas, then it's not a bad idea to wait for mortgage rates to drop further. Because if we take a look at this logically, if mortgage rates continue to drop and we see rates at around 5.5%, then we will see more buyers jump into the housing market, right? There will be more competition. But if you're in a market that has ample inventory out there, where there's a ton of homes on the market, there is going to be enough inventory for the new competition that enters the market. And as a result, I don't think you will see home prices shoot up, at least not right away. So in those markets, it's probably better to wait for rates to drop a little bit further and then get a property for a good price, because there's not much competition out there with lower rates. However, if you are in a market that has limited inventory, somewhere like Vermont or somewhere like Detroit, where there are much fewer homes on the market today than there were in 2019, I think it's better to purchase a property now, or at least continue to search for that home, right? You might not find that right property now, but don't take yourself out of the housing market just because mortgage rates will lower moving into the future. I personally am in the housing market right now and am looking to purchase a property in the near future whenever the right opportunity hits the market. And that's because I can always refinance down the road if rates do drop significantly, like I expect they will. However, if I wait for rates to drop significantly and more buyers jump into my housing market here in Vermont with little inventory, then there's going to be more competition, right? More buyers will be competing for the limited amount of inventory that's out there on the market, which is likely to drive home prices up. I know how difficult it is to purchase a home when there's 5 offers on the table. It's really frustrating. It's really hard to do, and you end up paying well over list price. Personally, I would rather buy a home where I am the only offer. I get it for list price or below. I get all my contingencies. And then when rates drop moving down the line, I can always refinance my home into a lower rate and have that lower monthly payment. Now, personally, in my market and in these low inventory markets, it's extremely unlikely that home prices are coming down. So that's not even something I am really considering. We are not going to see a housing market crash across the country. And although in markets with more inventory like Florida and Texas, home prices are declining slowly. So basically the big story here is inventory is the main driver. If you're in a market with little inventory, my recommendation, what I'm doing as somebody looking to buy a home in a market with limited inventory, is to continue to look, wait for that right opportunity, and jump on it whenever that opportunity hits the market. However, if you're in a market with an excess amount of inventory, then it's not a bad idea to wait for rates to lower, because home prices likely won't jump up immediately when more buyers jump into the overall housing market. Now, we're going to dive into what's going on with mortgage rates, what happened, and why I believe mortgage rates are going to continue to drop as we move throughout 2025. But before we do, my name is Liam O'Reilly. I'm a realtor here in Vermont with Jerry Riley Real Estate. If you have any real estate needs, whether it's in Vermont or anywhere else across the country, all of my contact information is in the description. Reach out to me directly, call, text, or email. I'm happy to help you. So let's get into the first source here. Okay, so we're over here at Mortgage News Daily just to take a look at what's going on in the mortgage market. We can see here that Wednesday's rate trend was positive. The average 30-year fixed rate mortgage sat at 6.78%. East Rise Credit Union, which is a local credit union here in Vermont, the best 30-year fixed rate mortgage you could get is 6.375%. Mortgage rates have been floating at around 7% before this week. And so this is a very significant drop in mortgage rates. And the main driver in that is the 10-year Treasury. We saw the 10-year Treasury. This is a chart of the past 5 days. We saw about a 0.25 percentage point drop in the 10-year Treasury over the past 5 days, and they trended down significantly today as well. We see these big drops. It did spike up towards the end of the day here, but overall, the trend is low. Now, something to keep in mind is that the market is in a very volatile place right now as it's trying to adjust Trump's policies and the overall US economy. Some negative economic data came out. There's anticipation of higher unemployment from all the job cuts to federal workers. But at the same time, if the inflation reading on Friday comes out hot, we could see the 10-year Treasury spike back up and we could see mortgage rates rise with it. So it's going to be a bumpy road as we continue to lower mortgage rates. It's not just going to be a straight line or a straight jump down. Now, the one caveat to that is that if we do enter into a recession and the Federal Reserve drops rates significantly and starts stimulus quickly, then we could see a quick and sudden drop in both the 10-year Treasury and the 30-year fixed rate mortgage. But what's most likely to happen, again, barring any recession, is a bumpy road down where rates drop for a period of time and then they come back up and then they drop. We can see here that we're at about the same mortgage rate that we had in mid-December. The 30-year fixed rate in mid-December was at 6.2, or excuse me, that was September. Mid-December was 6.81 was the low for the average 30-year fixed rate mortgage. Today we sit at 6.82. So basically the same levels as December and trending down. And it's been trending down consistently for the past 7 days, which is a great sign to see. Now, why do I think mortgage rates are going to continue to trend lower? Well, the title of this article out of Housing Wire is a great question to consider. Can government job cuts lead to lower mortgage rates for the spring? Right? As government layoffs happen, unemployment will tick higher, especially as private sector layoffs combine with those government layoffs. We are likely to see higher unemployment, which of course is not something that the Federal Reserve wants to see. They don't want major unemployment. They're trying to avoid a recession. And so I think if we see unemployment start to rise as a result of the budget cuts and the job layoffs that are likely to take place, then we're pretty likely to see the Federal Reserve cut their Fed funds rate and the 10-year Treasury to drop. And this is part of the reason why the 10-year Treasury and why mortgage rates are already dropping. If we take a look down here, it's this highlighted section. The White House is looking for a lower 10-year Treasury yield, and the bond market has in the past gotten ahead of the Federal Reserve when it smells an economic growth scare. This has meant that the 10-year Treasury and mortgage rates go lower. So essentially the Treasury market and the mortgage market, they try to get ahead of what the Federal Reserve will do with their rate cuts. And that's why yields drop ahead of the Federal Reserve making any decision. The moves tend to happen before the Federal Reserve's meeting, as opposed to actually when they cut the rate. Okay, so scrolling down here, they have a 10-year Treasury yield where they see the steep decline that we just highlighted by zooming into the 5-day mark. Now, something else to keep in mind is the spread between the 10-year Treasury and the 30-year fixed rate mortgage. Now, this person who's writing this article predicts this spread to drop by about 75 basis points, by about 3/4 of a percentage points, which means the average 30-year fixed rate mortgage could drop down from 6.8% down to about 6% without the 10-year Treasury moving at all. That's the spread between where the 30-year fixed rate mortgage is and the 10-year Treasury is. So if we take a look here, historically, these spreads have been between 1.6 and 1.8%. If we were experiencing the worst mortgage spreads of 2023, mortgage rates would be about 3/4 of a percentage point higher than where they are today. So in other words, if the spread was as high as what we saw in 2023, mortgage rates would be at about 7.5% as opposed to the 6.8% that we're seeing today. Conversely, the current mortgage rate would be about 0.73 to 0.83 percentage points lower than it was today if it was at that historical level. So this person is expecting an improvement by about 0.27 to 0.41 percentage points by the end of the year. So about a 1/4 percentage point drop just by this spread lowering, just by the difference between the 30-year fixed rate mortgage and the 10-year Treasury starting to converge. If we take a look here, we have the chart. We see we're at about a 2.33 percentage point spread, lower than where we were last year, lower than where we were in 2023. And as more economic data comes out and the market starts to feel more secure about where mortgage rates are going, and as mortgage rates lower, we will likely see the spread between the 30-year fixed rate mortgage and the 10-year Treasury start to converge. Again, another factor which is likely to bring mortgage rates down as we move throughout 2025. Now, if we take a look here, mortgage purchase applications, weekly pending sales, not something that we're going to talk about in this video, but the last point I wanted to touch on is active inventory and new listings hitting the market. If we see here, inventory is much higher than what it was last year. Weekly inventory levels, and they're only looking at single family homes. So some data, like the data we look at in Redfin and with the Federal Reserve, those include both single family homes and townhomes, and sometimes they include 2 to 4 unit properties as well. This data is only looking at single family homes, which is why the numbers are lower than what we saw on Redfin and the Fred's website in recent videos that I've posted. So we see here, the weekly inventory change from February 14th to February 21st, inventory rose only by about 3,000 homes that hit the market. But the big thing to look at is there's about 200,000 more properties on the market this year than there were last year. We see here 29% more than last year. And now, while the inventory is up across the country, even in tight inventory markets like where I am in Vermont, it's up most in markets like Florida, like Texas, like Colorado, that have seen these large increases since 2019 and had a ton of building during the pandemic, right? Markets like Vermont and many places here in the Northeast, yes, there's been building in recent years, but not nearly as much as what you see down in Texas or down in Florida. So 29% year over year increase in new listings. It's certainly a welcome sign for the overall housing market, but you can see here, we're still well below 2019 levels. So if we're not even at 2019 levels, that means we're nowhere near the levels of 2008 and 2007 when the last housing market crash occurred. And that's something that we have to keep in mind as we look at this data. Yes, the market is slowing compared to what we've had in recent years, but it's nowhere near the type of market that we saw during the Great Recession and the financial crisis. That's why I'm saying there's not going to be this massive national housing market crash. Yes, markets with more inventory than what they had on the market in 2019 are seeing price declines and will likely continue to see price declines as long as that inventory remains high. But most of the market, most of the country still has less inventory than what they had in 2019 and is at an inventory deficit as opposed to a surplus would cause the national housing market crash back in 2007 and 2008. When we take a look at new listings data, again, this is just a good reference point back to 2008 to show how tight things are today compared to where they were in 2008. So we see here, last year, the author of this article forecasted that we would get at least 80,000 new listings per week during the seasonal peak spring season. That didn't happen last year. However, he's expecting it to happen this year, right? 80,000 listings per month. It would be much higher than 2025, 2024, or 2023, with about 50,000 in 2025 and 2024 and 40,000 in 2023. However, the data line during the peak years of the Great Recession ran between 250,000 listings and 400,000 listings per week. So the prediction, which is 30,000 more listings per week than what we saw last year, it's certainly more listings than we've seen in recent history. It's still about a third to a quarter of what we saw during the great financial crisis. Again, this is why it's such a different market than what we saw in 2008. And I think, expecting the same results when all the data is telling a completely different story is just not a smart thing to do. So to conclude this video, mortgage rates are likely to trend down based on what I'm seeing. I think there's economic concerns throughout the economy, and mortgage rates are likely to be affected by those concerns with unemployment and more layoffs likely to take place moving into the future. Now, at the same time, there are inflationary pressures with tariffs and things along those lines. But overall, the economy is slowing. There are signs that the 10-year Treasury will continue to drop as we move throughout 2025. But that being said, it's not going to be a straight drop. It's going to be a bumpy road, and there's no way to know exactly where mortgage rates will end up by the end of 2025. If I were to guess, I think it would be somewhere between 5.5% and 6% by the end of 2025. But we don't know that for sure. I do certainly think they'll be lower than where they are today, which is an average rate of 6.82%. But regardless, I'm in a market that has limited inventory. I'm still out there looking. And when the right deal hits the market, I will be buying a property in 2025. So thank you guys so much for watching. I hope you enjoyed the video. Leave me a comment. Let me know what you think, and I'll see you in the next one.